What the heck just happened to the stock of Uber Technologies? The ride-sharing and food delivery platform reported this morning, even though I thought the quarter looked pretty darn good, Wall Street clearly disagreed with me, as the stock plunged more than 5% today in response. Now, I've been a big backer of Uber for the past few years. I even recommended it in How to Make Money in Any Market, and the stock's been a huge winner. It's up more than 50% for the year, even after today's pullback. Not bad, huh? So then we have to ask, has something gone wrong here? Or has the market made a mistake, creating a nice buying opportunity? I think, you know what? It's the latter. I'm going to tell you why. When you dig into the numbers, they were pretty darn impressive. Uber's trips, gross bookings, and revenue grew by 22%, 21%, and 20% respectively, all coming in well ahead of expectations. Monthly active platform customers were up 17%, okay, in line. Uber's operating income came in a little light, but they earned $3.11 per share when the analysts were only looking for 69 cents, although most of that's come from a massive $4.9 billion benefit from a tax valuation release. Back that out, it would have been a much smaller beat, but that's still good. Looking at the company's individual businesses, Uber Eats was the star of the quarter, 25% gross bookings growth, 29% revenue growth. No, those are fantastic. The larger mobility segment, rideshare, that's solid numbers, too. They were just more in line with expectations. Gross bookings and revenue both grew 20%. Uber's last segment, freight, is fine. It's not big enough. All expected. Let's not even think about freight after this, okay? But freight is still something that I remember. If you remember, I once introduced freight to us. I still hope it's going to be something big, but not yet. Finally, Uber gave strong guidance for the current quarter with a healthy gross bookings outlook, although their EBITDA forecast was essentially in line with expectations. So now let's put it all together. I think you had a pretty good, albeit not perfect, quarter. So then why did the stock get hammered if it's still pretty good? First, some of it's clearly because we had a real bad tape today. I mean, some of it's because there was particular weakness from travel stocks. Think about those soft numbers from Norwegian Cruise Line on top of the Royal Caribbean last week, and the whole momentum cohort just got slammed, and that's because of the Palantir, let's say the Palantir earthquake. Uber's arguably part of both these groups, so today was going to be rough no matter what. At the same time, the quarter had its issues. Specifically, Uber's margins came in a little light, and I think that's another reason why the stock got slammed. Margin softness could be a sign of increased competition, right? In food delivery, Uber has intense competition from DoorDash, the company I like a lot. And in ride-sharing, Lyft, we've been featuring them. They've been doing much better, while investors have one eye toward the future with robo-taxis from Waymo. Now, Tesla and others, look, that could all present a problem. Robo-taxis could be an issue, but I've never believed it will ultimately matter. Oh, by the way, Uber and Waymo are partners in a few test markets, for heaven's sake. Investors, though, love to freak out about autonomous driving and Uber. I say don't think like that. That said, I'm not too worried about Uber after this report. Slight margin miss. I saw one take from an analyst, BTIG, Jake Fuller, made a lot of sense. After agreeing that margins were the culprit behind the stock sell-off, as I just said, he wrote, quote, Uber continues to strike a balance between top-line growth, margin expansion, and investment, but has clearly tilted more this year toward reinvestment versus margin expansion in 24. Is that bad? Not at all. In our view, as growth is accelerating. Uber is beating on bookings, revenue, and EBITDA. Dollar results are in line to ahead, end quote. In other words, he thinks it's buy. I got to tell you, I think he put it perfectly. Like I explained in How to Make Money in Any Market, growth is the best protection you can have in a rough stock market. And right now, Uber's growth is accelerating, which is the best kind of protection. Their mobility business saw its best gross bookings growth in 6 quarters, and the delivery business had its best growth since the second quarter of 2022. Hey, by the way, Uber Eats is roaring right now because the company's made an aggressive move into the grocery and retail space as opposed to just restaurants. And Uber's finding a lot of success there. While that comes with some additional costs, I still think it's a great move because it drastically increases the company's addressable market. This was a point that Uber CEO Dara Khosrowshahi made during his interview in Squawk Box this very morning. So let's step back a second and think about Uber's overall goals. They want to grow their market share in both ride-sharing and delivery. They want to grow engagement with their customers, encouraging cross-selling. And as part of their goal, they want to grow their Uber One membership program, which comes with great benefits. And they want to do it all profitably. They're clearly making progress on each of these fronts. Uber's growth is accelerating across both ride-sharing and food delivery, and management said customer engagement is improving too, up 4% in the quarter. Better engagement is a huge positive for Uber because people who use both ride-sharing and food delivery spend 3 times as much more with Uber and retain 35% better than users who only use one product. I think that's pretty terrific. Plus, the company still has plenty of room to go on this front. In places where both ride-sharing and food delivery are available, only 20% of Uber's users utilize both services. Management also seems pleased with the progression of Uber One, with those members much more likely to use both ride-sharing and Eats. As for the company's profitability, sure, margins were a teeny tiny bit light this quarter, but Uber is still making tons of money at this point. Adjusted earnings for interest, taxes, depreciation, and amortization still grew at a 33% clip year over year. So who really cares that it came in with a slight miss? I've got to tell you, I usually don't like to overlook that, but in this case, I'm fine with it. Here's the bottom line. As far as I'm concerned, Uber, which I was very concerned about because I wrote about it in the book. I didn't want it to be wrong, for heaven's sake. Uber's doing better than I thought it was doing. And I think, I got to tell you, I think there's not much to worry about, really. The stock reacted negatively because Uber happened to report on a day with a tough tape and because of some slight misses for profit margins. But I love the revenue growth here, which is accelerating. I love the improved engagement. And I think the company's focused on a clear strategy that it's executing quite well. That's why I don't think there's anything to worry about from the Uber quarter, and it's why I'd be a buyer into weakness after today's pullback and tomorrow's uncertainty. Stay with Mad Money.
Coming up, Cramer's getting a read on real estate and diving into Simon Property Group and seeing what the shopping mall owner's latest earnings say about the state of the consumer. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.